I've come across many investments in my time, especially when I used to be a financial advisor, and here are the 5 that I think you should stay away from, especially if you're a long-term investor. What I've noticed about all of these investments is that they're all pretty common, and you're likely gonna come across at least one of these in your life. Now, since you're my friend, I want you to be aware of these. This list will start from the most obvious to the not so obvious, so make sure you stick around for that. Now, starting off with number 1, that's leaving your excess money in a savings account, especially if it's at a big bank. The obvious level of this one is about 5 stars. So the most obvious that it can get, because keeping your cash at a really big bank is only paying you about 0.05% APY. On $10,000, that's only $5 per year. So I think it is actually okay to keep some money on the sidelines and not having to have it invested, just in case you come across some opportunities or the volatile market. I mean, the market is very volatile. However, if you're having your excess cash in not a high yield savings account, so if you just have it at a big bank, I think you're losing out on a ton of value. A lot of the high yield savings accounts right now are paying about 4% per year. So on an investment of $10,000, that's $400 in free money that you could be getting just if you're not lazy enough to keep your money in a big bank. If you're looking for a high yield savings account, just Google high yield savings account and you're likely going to find at least one that you feel comfortable with. And all you really have to do is make sure that it has FDIC insurance. And what that does is covers you just in case the bank goes bankrupt. I know that's probably not going to happen, but I just wanted to point that out. Also, if you want some immediate returns on a smaller amount of money, say under $10,000, you can still buy Series I savings bonds. And these are savings bonds that are backed by the US government, and they're paying about 6.89% per year right now. There are some nuances to it though, so you might want to read up on that. I'm going to link a resource down below for you guys, and you can buy those on treasurydirect.gov. But for the most liquid option for your money, the high yield savings account is probably going to make the most sense, because then you can take out your money whenever you want. Now, depending on when you watch this video, rates might change. So before you do or take any big action, make sure you check on the rates of your high yield savings accounts, as well as the Series I saving bonds and any other rates that you might find. All right, moving on to number 2. This one is not so obvious, but I will still rate it a 4 out of 5 stars. And these are leveraged funds. This is a type of investment that amplifies the return of whatever you're investing into. In the most common scenario, a leveraged fund will track an underlying index, and they will use financial derivatives like options to try to amplify those returns. That sounds way more complicated than it should be, but it basically means this. So if an index you're tracking is up 1%, you should typically be up 1%. But however, if you invest in that index with a leveraged fund, say a triple leverage fund, if the index is up 1%, that means the fund will be up 3% or 3 times that. That sounds good and all, but let's say the index is down 1%. It actually amplifies your losses too. So in a triple leverage fund, you would actually be down 3%. These financial instruments are usually used for short-term trading and are usually highly volatile. If you're a long-term investor, you're gonna wanna stay away from these because of 2 things. First is their expense ratios or yearly fees. They're really high, so they're often over 1% per year, which will eat into your returns. And number 2, there's a phenomenon called volatility decay. And this basically means if the index has a lot of ups and downs, like it's going up and down like a roller coaster, with investing with a leveraged ETF, what you'll actually find is even if the index breaks even, but the index is super volatile, you'll still lose money. So let me illustrate this for you. So let's pretend there's an index that starts at 1,000. The index rises 3% on Monday, goes down 7% on Tuesday, goes up 4% on Wednesday, down 6% on Thursday, and then on Friday it's up 8%. So basically it went up and down throughout the week. At the end of the week, the index in the blue line here ended at 1011.36 without any leverage. So it was actually up a little bit over 1%. With a triple leveraged ETF, your results are 980.63 at the end of the same 5 days. Now, why is this? The market moved the same each day, but you're telling me that the leveraged fund is down? This is because when any investment goes down a certain percentage, it actually takes a much larger percentage going back up to break even. For example, a loss of 10% requires you to get an 11% gain to recover. A loss of 30% would require a 43% gain to recover back to break even, and that's the issue here. Let's say your index goes down 10%, that means with the leveraged fund, you're actually gonna be down 30%. So if the underlying index then goes up 11% the next day, with a normal index, you'll actually break even, but because of the leveraged fund, you're only gonna be up 33%. 8%. That still comes up short to the 43% gain that we would need to break even. So as losses get larger, the return required to break even increases at a much faster pace. These are really dangerous if you don't know what you're doing, so if you aren't a sophisticated trader, I would just stay away from triple leveraged funds. Before we move on to number 3, I want to share some good news with you guys, and that is my free newsletter Hump Days is available twice a week. So we cover business and the economy, and we currently have over 12,000 readers. Now, we put a lot of time and effort into it, so if you enjoy the content here on video, you'll probably also enjoy that. The link will be down below for that, and let's actually move on to investment number 3. The obvious level on number 3 is a 3 out of 5 stars, and it is actually whole life insurance. I want to point out that I know that whole life insurance is technically not an investment. However, it's always being advertised to you as an investment because of the cash value portion that they try to sell to you, and that's what we're going to talk about today. To understand how whole life insurance really works, we should explain to you what term life insurance is, because that's the really simplified version of life insurance, and that'll show you how bad of an option whole life insurance is for most people. In term life insurance, you pay a set amount every single month for a death benefit. So for example, for someone who's 30 years old, they'll pay roughly $20 a month for 20 years, and they'll have a $500,000 coverage policy. Think of it like car insurance. You pay 20 bucks a month or $240 a year, and in the case you pass away, your beneficiary will receive about $500,000. After 20 years, the coverage ends, and at that point you can renew it, and it is that simple when it comes to term life insurance. Now, whole life is very different. You pay a very costly monthly premium, or monthly fee as they call it, and that fee is often in the hundreds of dollars per month. The average cost of premiums for a whole life insurance policy is usually 20 times higher than that of term life insurance. So for the average 30-year-old, that's going to be $421 per month. That's about $5,000 per year. Now, the premiums go to funding 3 things. Number 1 is your own death benefit coverage, so that $500,000 policy that we talked about earlier. Number 2 is your salesperson's commissions. And then number 3 is your cash value. And that is what's different about whole life insurance that the insurance salesperson will try to tell you about. They'll say it's a savings component that you can invest and grow with tax advantages. But the truth is that for the first 5 to 10 years that you're funding these monthly premiums, they're actually not going towards your cash value. They go to paying none other than your salesperson in commissions and administration fees, and they go towards funding your own death benefit, and they barely go towards your cash value. So the fees in this case are really front loaded, and that's actually causing a ton of opportunity cost here. Take our example above. The difference between whole life and term is going to be $400 a month or $4,800 a year. You could just buy term life insurance instead and invest the difference of $400 a month, and if you compound that at 8% in the market over 20 years, the ending balance is going to be $219,000 and change. A whole life insurance cash value typically returns an annual return of 1 to 3.5% after fees. So after a period of 20 years, the ending cash value is going to be about $142,000 at the high end of that return. Lastly, if you want to use your cash value at any time, you actually have to borrow against it, which sounds nice in theory, but then you actually have to pay a percentage on that money. You're paying a percentage on your own money to actually borrow it from your insurance policy. The purpose of life insurance, in my opinion, if you're 30 years old, is you want to ensure that your kids get to their adult years and that your spouse is taken care of in case of an unexpected passing. So for most people, I think a term life insurance of around 30 years should cover most of those bases, and you don't really need whole life insurance. There are going to be some people in the comments today that say whole life insurance can be beneficial for certain situations, and I do agree. For certain special situations, like let's say you have a child with a lifelong disability and you want lifelong coverage, it could be useful to have whole life insurance. But if you don't have a specific situation like that, it's generally a bad deal. Let's move on to number 4, and that's actually going to be a very common investment in the financial advisor world. It's called a loaded mutual fund. The obviousness level here is a 2 out of 5 stars. Now, if you don't have a financial advisor, you can feel free to skip this section because it probably doesn't apply to you. However, this goes on in the financial advisory world quite a bit. Mutual fund companies can have several types of shares, but the most common are A, B, and C shares. The difference in these shares is usually how the fees are collected. So with A shares, a lot of the fees are up front, and the mutual fund company will try to justify it saying, hey, your expense ratios are going to be lower in the long run, especially if you hold this fund for over 40 years. Now, front-loaded fees can actually be up to 5% or higher. So for example, if you buy a mutual fund with a 5% front load and you invest $20,000 into it, $1,000 of that is going to a fee that's going to pay for the commissions for your advisor, and this causes a conflict of interest, in my opinion. You're going to have to do the math for yourself on if these funds are good for your time horizon, but A shares are typically not a great deal. So let's actually take a look at this example here from American Funds, ticker symbol AMRMX. You can see that the front-loaded fee is 5.75%, and you're usually going to be told that if you invest at least $25,000 into this fund, your fees will drop, but they usually just drop 0.5 to 1%, which is still not enough. I personally like to stay away from mutual funds due to their high expense ratios, and I usually opt for a passive index fund instead. You're gonna get similar performance without the fees eating into your returns. All right, the last investment that I think is poor for a long-term investment time horizon, and I'm really going to have to emphasize long-term here, are commodities like gold and silver. Now, this is a hot take, and before you come for me in the comments, I know that people love commodities, and in 2023, depending on market conditions, they could actually outperform the market this year. But gold in the very long term is not a really productive asset, according to Warren Buffett. His biggest issue is the fact that gold is just so worthless. According to him, it's not in the value someone is willing to pay for an ounce of it, but in its ability to create wealth. So let's actually take a listen.
Let's say you'd taken that $10,000 and you'd listened to the prophets of doom and gloom around you, and instead you'd use the $10,000 to buy gold. You could look at it and you could fondle it and you could, whatever you wanted to do with it. But it didn't produce anything. It was never going to produce anything. And what would you have today? You would have 300 ounces of gold, just like you had in March of 1942, and it would be worth approximately $400,000. So if you decided to go with a non-productive asset, gold, instead of a productive asset, which actually was earning more money and reinvesting and paying dividends and maybe purchasing stock, whatever it might be, you would now have over 100 times the value of what you would have had with a non-productive asset.
Essentially, he's saying he'd rather own a productive asset that compounds and grows over time. Gold's value rises and falls depending on what someone is willing to pay for it, not in its ability to provide income for the owner. Now, of course, this comes with a big caveat. Gold can actually outperform the market, especially in times of geopolitical uncertainty, and it also becomes a good inflation hedge. In fact, there are even stretches of 5 to 10 years where gold can outperform the market. However, if we zoom out far enough, you'll see that gold pales in comparison compared to the market as a whole. So let me know in the comments what you guys think of these investments, and make sure to sign up for my free newsletter Hump Days, where we come out with 2 editions a week on the business and economy. That'll be linked down below. See you guys in the next video. Thank you for being here.